You might all agree with me when I say that everything bad has happened at the onset of 2022, which is depressing. We all saw what happened in Ukraine during this crisis, Russia being the most sanctioned country in the world, and the uncertain COVID policies in China, specifically the zero COVID policy. Not to mention the inflation rates to continue to rise, as well as interest rates being raised by the US Feds or the US Federal Reserve. All of these are anticipated to suppress the growth of the economy. The trouble is whether aggravated situation or policy decisions that are based on wrong advice would be the reason for the economy as a whole to continue to collapse. The chance of a recession happening is 35%, as mentioned by Mark Zandi, one of Biden's most favorite economists. The underlying truth is that when a country is struck by a recession, it's always advisable to have a perspective that is long-term and to control your risk of financial losses. This simply means to save your investment money or stay liquid until such time that the economy has recovered. Although no one can ever foresee the happening of a recession, it is better to diversify your assets or investment early on in order to safeguard your money and to be in a good position to gain revenues when the economy recovers. Now, let us discuss and try to understand the key elements that contribute to a recession before even thinking about whether a recession is going to happen or not. We also need to take into consideration what it's like during the past recessions. The United States has suffered from recession many times over the past years. These recessions were fatal and more disastrous than others during the past 2 decades solely. COVID-19 pandemic in 2020 has caused a short-term recession, which was said to have ended the extended length of economic growth and security that Americans have experienced in history. In spite of the fact that this decline in the economy was seen only for 1 quarter, it was still labeled as a recession by the National Bureau of Economic Research. There was a sudden rise in the unemployment rate, companies and businesses were compelled to close by government authorities, a massive lockdown put in place, sales from retailers submerged, the sinking stock market was evident, and others. A lot of people have considered this recession in 2020 as the most terrible one that happened in US history during this modern time. It caused such damage and chaos in every brief span of time. The Great Recession was suffered by America from 2007 until 2009. Since the Great Depression experienced by the Americans in the 1930s, this 2007-2009 recession was the worst economic plunge in the US. Interest rates on mortgages were very low in order to attract buyers to own properties. This scenario caused what they called a housing bubble. During a housing bubble, there were very few buyers in the market as compared to a very large amount of sellers. This happens in the middle of the year 2000s. A lot of people resulted in a default in their mortgages when this housing bubble popped. This whole scenario caused a recession and a financial crisis across the country. There was a decline in the economy by 4.3%, while unemployment peaked at 10%. Uncertainties were seen among many Americans and businesses during the start of coming century in 2001. There was a pump and dump in dot-com businesses during that time, which was made even worse by the fear of the Y2K bug. If you would remember, this Y2K scare created fear about how the transition would occur in terms of technology during the years of 1999 and 2000. The September 11 bombing by terrorists caused a real concern globally that initially affected the stock market and eventually causing a huge impact on insurance business and aviation. Even so, the recession in 2001, when compared to other recession of 2007, 2009, and 2020, was milder, with a 6.3% in unemployment at its peak and gross domestic product declining for just 3 quarters, decreasing cumulatively by not more than 1%. Now that we have learned about the short history of the recession, we are now ready to identify causes or reason why a recession happens and the different signals that we need to spot on. Number 1. A decline in gross domestic product. A decrease in the growth of the gross domestic product is said to be the common reason for recession. However, it is more likely to be considered a sign that is going to happen. The reason for this is that it is only after the end of the quarter that economic statistics are released and reported, and the moment that the GDP has been calculated after several months, the recession has already been taking place. Focus on this. According to the Commerce Department, GDP declined by 1.4% in the first quarter base annually, which shows an intense economic reversal that had just experienced growth in the economy following 1984. Number 2. Rise in interest rates. People are hesitant to put more liquidity in the market if there are high interest rates. This means that the available money the people are willing to invest decreases in a given economy. Past data showed that the frequent increase by the Federal Reserve on the interest rates was mainly done to protect the value of the US dollar. For instance, the recession in 1980 was a result of their actions and measures to fight stagflation. Having said that, in order to fight inflation, and this is the greatest inflation in the past 40 years since 2018, the cost for borrowers will be higher, with a reduction in the economy in terms of the money people would lend and spend. According to some experts, this action of increasing the interest rates will be seen being enforced by the Feds strongly as expected in 2022 and 2023, and a lot predicts that the Fed will be raising the target rate of the federal funds to about 3% at its peak towards the latter part of 2023. Deutsche Bank has forecasted that the Federal Reserve will submerge the US economy into Great Recession before we finish 2023 by raising interest rates up to 5% or 6%. Number 3. Crash in the stock market. A sudden decline in the trust of investors can result in a bear market, exhausting all the money from venture capitalists. But the month of March was seen to be in favor of investors in stock market, as reported by the Forbes advisor, as compared to the months of January and February in the United States. Now take a quick look on this one. A gain of 3.6% for the month was seen by the S&P 500, a clear indication of a good rebound from the painful correction during the past 2 months, with stocks falling as low as 13% compared to previous all-time highs. During the first quarter 2022, the biggest losses were seen from among the major benchmarks in the market, with a 2.8 loss for the S&P 500 and the Nasdaq Composite to drop at 3.95%. Number 4. Restrictions on wage and prices. If you look at history, there were several instances when the authorities imposed wage and price restrictions, but among those restrictions, there was only a single time that led to a recession. To give you an example, during the reign of President Nixon in 1971, he ordered to freeze the prices and wages in order to fight inflation. But since business owners during that time could not afford to pay their workers, they had to lay them off. And because of low family income, the demand for goods and services drastically reduced. As businesses could not reduce their prices, they had to cut off their workers as they could not pay them, which caused a recession in 1973. As reported by CNN Business, there has been a warning issued by the Bank of America that too much inflation creates a real threat to economic recovery, which had only begun last 2 years. It was last Tuesday that new data was released showing an increase in consumer prices by 8.5% last March, which was considered to be highest rate from December 1981. Things like clothes, shoes, grocery items, cars, and many others had shown some increase in their prices year after year. Number 5. Decline in housing sales and prices. In a scenario where homeowners could not pay their loans and could not also avail of a remortgage, this happened during the Great Recession in 2008. Several banks declared losses due to deals that fell off. Improvements were on the housing market in the current year, with a continued increase in home prices even facing inflation rise continuously and given problems involving supply chain. But soon, as some experts say, prices will equalize as the demand decreases and as rates in mortgage increase as well. There is an even increase in the interest rates in the long-term period, with a nearly 3% on the 10-year Treasury note as prepared by the Feds, with the intuition of cutting its portfolio by about $5 trillion in Treasury and securities backed by a mortgage in the following month. There has been an increase by about 5% in fixed mortgage rates recently, brought about by the tightened monetary measures of the Federal Reserve, which will result in a gravitational pull that is strong on the prices of houses, as believed by Chief Economist Mark Zandi. According to him, more mortgage rates will conflate with extraordinarily high house prices, making home ownership attainable for most Americans. He then continued by saying that currently, the average payment of mortgage per month that amounts $1,700 is said to be around $500 more than compared to the previous year, and more than twice as compared to what they paid 10 years ago. As per Zandi, current homeowners will think twice about selling and taking mortgage rates of 5% or higher after seeing the all-time low records of mortgage rates during the pandemic. The fast increase in the prices of houses in a short time period will reverse because of inventories being limited and, of course, because of inflation. A lot of buyers are priced off the market and increasing mortgage rates and hold back price growth in the latter half of 2022. Number 6. Demand and supply. At the onset of a recession, hand, demand for loans might be chaos. We see plans of expansion and growth by companies being withdrawn, which would have been funded by financing. This is if there is an indication of a strong economy. This results in many people choosing to save their money and minimize their spending. During a financial difficulty, lenders may also withdraw, risking the economy to experience what they call credit crunch. This happening will need central banks to step in the way to prevent imminent threat to the economy. Interest rates continue to decline during a recession for the reason that loan demands are reduced, thus increasing the availability of savings. Finally, a pandemic. At the beginning of 2020, the economy worldwide has been affected badly. It forced developing countries to close their whole economy, which resulted in one of the worst among many recessions that have been written in history. People were still cautious to eat outside, go to movies, and other establishments when they tried to open again because of fear of contacting COVID-19. And because people lost their jobs, they had nothing to spend, and this incapacity to spend or unwillingness to spend on the part of the consumers resulted in a very long recession. In the third year of this COVID-19 pandemic, it has greatly affected the economy of the world, not only the United States. Several policies were made, such as providing fiscal stimulus and providing some relief to all areas impacted by the worldwide crisis. For instance, there was monetary aid, a series of them actually, that were given by the feds in addition to fiscal stimulus. $11 trillion were funded for all these measures in order to deal with the problems brought about by the pandemic, and this data was reported by USA Spending. That's it, everything you need to watch out for during a possible recession. I hope you can plan ahead, knowing all of these signs by now. Thank you for watching, and I will see you in my next video.